Imagine waking up one morning and your entire investment has dropped to zero. Not just yours, whole countries go into panic. The stock market isn't just numbers. It's full of emotions, big stories, and lessons that cost billions of dollars. In this video, we'll look at the 5 biggest stock market crashes in world history, what caused them, how they affected normal people and world economies, and most importantly, what we can learn from them to protect our future. Watch till the end. There's a special bonus waiting for those who stay. Let's begin. Because history might repeat it, or maybe not if you're ready. The Great Depression crash, 1929, USA. It was 1929. America was full of hope. Everyone, even normal workers, was putting money into the stock market. Why? Because prices just kept going up. People believed the market would never fall. Even taxi drivers were giving stock tips. Families invested all their savings into companies they didn't understand. But dreams can be dangerous. Behind the scenes, companies were overpriced, profits didn't match, and most people were buying stocks with borrowed money. This is called margin trading. People were paying 10% and borrowing the rest. 90%, crazy, right? Then came October 24th, 1929, Black Thursday. A few big investors started selling. Panic spread fast. Phones in broker offices rang non-stop. The next week, everything crashed. Billions of dollars disappeared. People lost homes, jobs, even hops. Some were so heartbroken they ended their lives. And it didn't just hit America, countries around the world suffered. Trade slowed down. Banks shut down. And we entered the Great Depression lesson. When greed takes over and people stop looking at reality, the market crashes. We must always be careful and never believe that prices will only go up. Black Monday, 1987, Global. October 19th, 1987, Black Monday. A normal day turned into a nightmare. The U.S. stock market fell more than 22% in just one day. To explain how big this is, imagine the Dow Jones dropping over 7,000 points today. That's huge. But here's the thing. There was no war, no natural disaster. So what caused the crash? Fear. People were already nervous, prices were rising too fast, and interest rates were expected to go up. Some investors started selling. But this time, computers made it worse. They were programmed to sell stocks automatically when prices dropped. So when the market started falling, the machine sold millions of shares at once. Panic spread from New York to London. Tokyo and Sydney. Billions were lost in just hours. Lesson: technology can speed up disasters, and fear is stronger than logic. Black Monday taught us that markets can break without warning, even without a big reason. The dot-com bubble, 2000. After Black Monday, the internet came. The 1990s brought a new dream: online companies. If a company added "com" to its name, its stock price went up fast, even if it had no profit. People started investing blindly. Stocks rose quickly. Everyone wanted a piece of the internet gold. But in 2000, questions started. Where's the money? Where's the business? The truth. Many companies had no real income. The bubble burst. The NASDAQ index dropped 75%. Trillions of dollars were lost. Many companies shut down. People lost savings and retirement funds. Lesson: don't fall for hype. New ideas are not always good investments. Check the foundation before investing in a dream. The global financial crisis, 2008. This one wasn't about tech. It was about greed. Big banks in the U.S. gave home loans to people who couldn't pay them back. Why? Because they thought house prices would never fall. They made risky loans, then sold them to other banks and investors. At first, everyone made money, but when people couldn't pay their loans, the bubble burst. House prices crashed. Banks started failing. One of the biggest, Lehman Brothers, went bankrupt. Stock markets crashed. Millions lost their jobs and homes. It was one of the worst crises in modern history. Governments had to spend trillions to stop total collapse. Lesson: greed and no rules can destroy economies. Financial systems need honesty and control. If not, everyone suffers, especially normal people. It all started with fear. Investors had been nervous for weeks. Market prices were going up too fast, and there were rumors that interest rates would rise. People started selling stocks quickly. But in 1987, something new made the crash worse. Computerized trading systems. These systems were programmed to sell stocks automatically if prices dropped too much. So when the market started falling, the machines kicked in and began dumping millions of shares instantly. The panic spread like a virus. From New York to London, Tokyo to Sydney. Markets crashed across the globe, billions were wiped out in hours. People watched helplessly as their wealth disappeared. And the biggest lesson, technology can speed up disaster. Fear is still the most powerful force in markets, even more than logic. Black Monday showed us that markets are fragile. Even with a